Hey everyone, welcome to a daily editorial on the KE Report, special Sunday daily editorial with our good friend Marc Chandler. Marc is the managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. Now, Marc, just a quick little look back on this last week. We had inflation data. That didn't really move markets. The one thing that moved markets for a very short period of time was Trump going after the Fed chairman, Jerome Powell, again. So we'll get into that. But first and foremost, just a quick overview on this inflation data. Inflation still is fairly stable. It's rising slowly, but very slowly, still meeting a lot of the expectations. There haven't been a ton of surprises that I've noticed on the inflation front, but inflation is still broadly holding above that 2% target. It's not back up in the 4, 5, 6% range, but it's in the mid to high twos, and that, quite frankly, is higher than 2%. And it seems very difficult, or it seems unlikely that inflation is going to get back to that 2% level that the Fed wants really anytime soon. So, Marc, what was your takeaway from the inflation data we saw this week?
I think you're right. I think it was relatively tame, though the headline was probably a little bit firmer than expected, and the core was a little bit lower than expected. The 0.3% rise in the month of June was really the biggest monthly increase since January. And the trick, though, too, is what people look at. Of course, they want to know about the year-over-year rate, and to really understand the year-over-year rate, we think about it as a base effect. So if we look at what happened last July, it rose 0.1%. And so if that gets dropped out for the 12-month comparison, we get the July print next month, it makes it look like the headline is likely to increase again. And so I think that the Fed, in this past week, we've had, I want to say, at least 12 Federal Reserve officials speak. And nearly all of them were saying the same thing. That is to say that despite the White House's criticism of Powell, that it's really been unanimous decisions at the Fed to keep rates steady this year. And I think that we'll still see in July, where the vast majority still look for keep policy where it is, to give some time then, since the labor market's been firm, to see if we get some more progress on lowering inflation. So the Fed says, and Powell says, I think many people at the Fed agree that the economy is in a good enough place to let them be patient for this restrictive monetary policy to weigh on inflation.
Yeah, Mark, it doesn't seem like the data that's come in so far, really all year, has been enough to move the needle to get them off that stance. And so they're still waiting, and there doesn't seem to be any real urgency, whether it's the job side of things or the inflation side of things on their dual mandate. But there have been several Fed heads that have come out and said that they would be more open to cutting rates. Now, when Waller said it, a lot of people just pointed to it as him positioning for Powell's job in 2026, but there's some genuine reasoning behind him wanting to cut sooner than later. Maybe unpack that for people that just see it as a ploy for the job, but really there's a thought process here that maybe they should start cutting sooner than later.
Well, I think that you're right that besides Waller, Governor Bowman also has seemed to be sympathetic to a July rate cut, and both of those got their positions from Trump and as governors. So I think some people I think are being very cynical about it. We've seen other people who Trump has appointed seemingly to swallow or to distance themselves from previously had principles for the sake of ambition. But I think that it's wrong to just simply dismiss Waller on these grounds. Waller, remember, was the head of research at the St. Louis Federal Reserve, and later became the head of the central bank, head of the Federal Reserve in St. Louis, and now the governor. And people who I know who know him thinks that he's got integrity. It's not about ambition. And so I think we should take his arguments seriously. And I'm sympathetic to those arguments, which is essentially that while inflation is a bit elevated, the reason the Fed ought to begin cutting interest rates soon is because the labor market's deteriorating. And that's really what Waller is coming down on. He thinks that, and remember, he was the head of research at the St. Louis Fed, and he goes through the data, and especially the jobs data, looking at the ADP data, non-farm payroll data, really breaking it down, drilling down into the data, and he thinks it's weaker than what it appears on the surface. And remember what happened too, that even though we gained private sector jobs, the aggregate hours worked actually fell. And so I think that Waller is in the camp, like his predecessor, that wants to take out an insurance policy to ensure a soft landing of the economy. Because remember, we usually take for granted that the labor market, these labor statistics, unemployment rates, these are lagging indicators. And by the time we really see the unemployment rate rise to whether, to whatever Psalms rule or to whatever rule one might embrace, it's too late to react because of the lag time with monetary policy. So I think Waller does have a strong case, but I don't think he's going to be persuasive to the majority of the FOMC. And I'm not sure, and he distanced himself from this as well earlier this week, that he didn't want to reveal whether it's raised to the level of dissent. It's one thing for a regional Fed president to dissent. It has a greater gravitas, a greater like heft to it if a governor does. And so a Waller dissent would be noticeable. But to me, what Waller's comments reflect really is that he's sort of like the canary in the coal mine. There are those bees that lead the rest of them. And so I think that what we're seeing is that even though the Fed most likely will not change policy in July, the market might have gone too far in downgrading the chances of a September cut. Most of the other Fed officials that spoke in recent days still seem to support 2 rate cuts, or at least a rate cut soon. Even someone like San Francisco Fed Daily. So I think Waller's comments should be taken seriously, and I think that the decline in the dollar on Friday reflected this sort of reflects the idea that Waller, while not a majority now, will be forming a majority in a few months from now.
So eventually, we are going to get some rate cuts out of the Fed, whether the market's pricing them in on the bond market or not. Seems like the equity markets might be pricing in a couple rate cuts because those recently hit all-time highs again. How do you see any rate cut, whenever it might come, filtering into the markets? Will it have an impact? Is it priced in? What's the fallout of a rate cut whenever it comes?
Yeah, even though I follow currencies and bonds and equities just on the very broad level, like the index level for stocks, what seems to be very revealing to me is that the stock market does not seem to be driven by interest rate expectations right now. First, we're in the middle of earnings season, and earnings look like they're coming in a little bit better than expected. But also, I think remember what happened in April. People said it was almost like people had the attitude the U.S. was no longer investable. And retail has poured back into the U.S. equity market. Insiders, corporate executives, they've been net sellers. And that's what concerns me really, is there was a bit of a fear of missing out. Retail investors jumped back in. And of course, as you mentioned, the NASDAQ and the S&P 500 made new highs this past week. I'm still a bit nervous about it. Even I see us at new highs, and of course my equity portfolio has done fine as well. But I am concerned that it's not really being driven by smart money, deep pocket money, the large pools of capital, but it's really being driven by retail investors. And that's what scares me. But in general, I'd say that even if the Fed cuts interest rates in September, why would they cut interest rates? Because they're concerned about the economy. Concern about the economy means headwinds for future earnings.
Well, Mark, one other element people are going to be listening in closely to as we get more earnings calls and more guidance is how the potential tariffs are going to affect the profit margins of companies. Because if we do see some of the tariffs go from 10% to, let's say, 15 to 20%, basically the companies are going to see a tax increase. And if it goes to 20%, almost double what they have now. And they either have to A, eat that and have less earnings and reduce margins, or B, pass along inflation to consumers by raising their prices. Where do you see that coming in as far as how it affects inflation, how it affects company earnings, the tariffs or potential tariffs?
Yeah, no, I think you're right. I think in some ways, there's 3 different economic agents that could absorb the tariffs. Foreign producers, they want to maintain their market share in the U.S., so maybe they would cut prices. So when you add on the tariff to it, the cost of their goods is still competitive. And there, it's interesting to look at import prices. Some of the cheerleaders for the administration have said, look, import prices are flat. That means that the tariff increases are not being passed on to U.S. economic agents. And the problem with that thinking is that the import prices that were reported last week do not include tariff prices. Those import prices are what it takes to bring it into the U.S. shore. To buy it when it's on the U.S. shore, that's where the tariff comes in. We also are seeing, to your point, that corporate earnings, even though a lot of businesses have mentioned it in their earnings calls, so far we're still seeing earnings, profit margins stay relatively healthy. And we've seen also, to your point, inflation has been, even though it's been rising, it's still relatively low. And what's happening there below the surface is that service prices have softened, while goods prices, especially those that you would suspect would be impacted by tariffs, say like clothes, furniture, some electronics, those prices have been rising a little bit. And so it does seem that some of it's being passed on to the consumer, but in a bigger picture, I think this is the concern, is that as people were anticipating the tariffs, businesses built up inventories. So they built up inventories with relatively cheaper goods. Now, in the past couple of months, those inventories have been run down. To replace them, those businesses have to pay tariffs. And so I think maybe it's a bit like this example I've talked about before about this butterfly that lives for a day and lands on an oak tree, a powerful big oak tree. But because the oak tree doesn't move while the butterfly is alive, the butterfly thinks the oak tree is dead. That is to say, it jumps to a conclusion. And I think that people have gotten a little bit impatient, waiting and waiting to see those tariffs impact. They haven't seen them, so they say it's not going to impact. And I think that, and this is part of Waller's comments as well, we shouldn't expect them immediately, but 3, 4, 5 months later, inventories draw down, businesses begin passing on costs to other businesses and to consumers. So people like myself, but also it's not just economists, but the Fed's got models that say if tariffs go up X%, what does this mean for inflation? What does this mean for growth? So I think that the uncertainty, what the models point to, higher inflation expectations, I think that reason to be cautious about what's going to happen going forward, and especially if it comes at a time when the U.S. economy might weaken. We were very distorted in Q1 because of the trade numbers and trying to beat the tariffs. We'll be distorted in Q2, maybe in the opposite direction, maybe get something a little bit above 2% growth. So we're going to be really watching carefully how the economy performs as we get into Q3. And we don't really get, we don't get July data until beginning in August. And the early call for non-farm payrolls looks relatively soft, around 100, 110,000.
Who knows when we're going to get these tariffs, what these tariffs are even going to look like. I think that's why the market is, for the most part right now, ignoring them, because they seem to just get put on and then get pushed off again, which is really impossible for these companies to plan around. But since we have earnings season upcoming and still everyone's talking about it, what have you seen so far in earnings? What are you expecting in earnings? Considering that still these tariffs, while they were kind of on, they're also very much off at the last quarter.
Yeah, that's an important point, is that because of the on and off again tariffs, the postponement of those reciprocal tariffs, I think that we're not really seeing it so much in the earnings. The earnings look solid, maybe even a little bit better than people expected at the end of the second quarter. So I think that that's part of the story with the stocks. I don't think it's really the full story, like I say, but I do think that we're going to see a change in tone about the tariffs in the coming months. I think that it's hard. Even if it's a wrong assumption, I think it's the most prudent assumption to make. I find that in a lot of things that we can't really always choose to be right, but we could choose which way we want to be wrong. And I think that being wrong because you see these tariffs at the highest level since Smoot-Hawley, and you say, well, this is going to likely fuel inflation. That seems to be more like a realistic assessment than saying, these tariffs are going to be absorbed. It's not going to be passed on to consumers. It's not really a tax. And so it's which way we rather make the mistake, I think. And as an investor, I'd rather make the mistake thinking that the tariffs are going to boost inflation, might squeeze profit margins, rather than having a more, I'd say, naive assumption of things.
Well, Mark, if we just game that out with 4D chess, and let's just assume that we do see an uptick in inflation, if that happens in a couple of months, won't that coincide at the exact time when the Fed is talking about cutting rates could that postpone them from cutting rates again if inflation was to say get up above 3% again?
Well, the core rate's pretty close to 3%, and we're probably going to see the PCE deflator, as reported at the end of this month, be a bit firmer than the CPI. But I think I'm really more in line with Waller about this. I think that what gets the Federal Reserve to cut rates is not that inflation is going to be near target. I think what gets the Federal Reserve to cut interest rates, to resume the rate cuts, is a deterioration in the labor market. And so far, to your point too, Shad, I think that the labor market deterioration is very slow. And if anything, we've seen for the last several weeks declines in the weekly jobless claims. And so so I think that reasonable people can differ about what's going to happen. But I think that I've been expecting the layoffs from the government sector, the challenges from immigration and the curbs on immigration, both legal and illegal, I think was going to begin taking a toll here in Q3. I think we got a little bit of a taste of it in some of the data, the private sector data that we saw for the month of June, and I think we're going to be getting more of that going forward. So I'm sympathetic to Waller's arguments that the labor market itself, the deterioration there is going to be the spur that gets the Federal Reserve to resume its rate cuts.
So, Mark, since we are in summer, it should be a little bit more quiet, but we never know what's going to come out of Trump because he can move markets, at least in the very, very short term, and we don't know if he's going to attack Powell again or go after any other country. What do we look ahead to this next week? Anything market moving?
I think there's three big highlights in the week ahead. The first is the flash PMI. Some countries some like markets don't pay that much attention to it, like Japan and Australia might not pay attention to it so much. I think that Europe is more significant, and oftentimes the flash PMI, the preliminary estimate, is so accurate that it steals the thunder from the final report. By the time we get the final report in a couple of weeks, the market has well absorbed it, and the final report has little market reaction. In the U.S., we really have the choices, really, the discrepancy between the PMI and the ISM. And I think the market puts more credence into the ISM. But anyways, for next week, we do get the flash PMI. The two other big highlights of the week will be the ECB meeting. And this ECB meeting, I think there's little, if any, chance that the ECB cuts rates again. The target rate, the deposit rate now is at 2%. ECB President Lagarde says the neutral rate, that R star, is about 175. And the market thinks that the ECB will cut rates either late this year or early next year and bring it down to that neutral rate, 175, and that could very well be the end of this ECB monetary easing cycle. The third highlight of the week seems to me to be the Tokyo CPI. And the Tokyo CPI sort of works in the way that the flash PMIs work. The Tokyo CPI tends to be it really gives a signal for the nation's inflation. And the national CPI doesn't get reported for like 2 or 3 weeks after the Tokyo CPI. And what's interesting about the Tokyo CPI is the headline rate has not risen since April. But we're still not seeing it filtered through fully to affect BOJ policy and the BOJ's outlook. Inflation is still elevated. In fact, this combination of elevated inflation in Japan plus the weakness of the Japanese yen has really been like a source of contention in Japan. Today, the Japanese elect go to the polls to vote for the upper house. The ruling coalition, the LDP and their junior coalition party partner, Komeito Party, lost the lower house majority last year. And it looks like there's a reasonably good chance they lose upper house majority this year. I don't think that's going to have much of a market reaction because they have a minority government, which really speaks to continuity. But if there's one issue that's really dividing the LDP and the Komeito Party coalition from the opposition is that the governing coalition is sympathetic to giving out checks to people to help them cope with the higher inflation. The opposition wants to cut the sales tax, the VAT. And so we'll see what happens. My best guess is that Prime Minister Ishiba gets penalized for a poor showing of the LDP party, and that he faces a leadership challenge later this year. And if the price of rice can fall a bit further, I think one of his big challengers is going to be the son of the former prime minister, now the agricultural minister, Koizumi.
All right, Mark, something to look forward to next week. But again, we'll see what comes out of Trump, because that can always change the direction of the markets and quite honestly change the direction of the week for all of us as well. Again, Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark II Market website. Mark, thanks for joining us on this Sunday. Hope you have a great rest of your weekend.
Thanks. Good luck to everybody.